We have seen tremendous volatility within a range of commodities, some of that due to European sovereign debt concerns, others due to slowing growth numbers in Asia. Nevertheless, sourcing professionals will want to keep a close eye on the following: the euro and US dollar, particularly as the euro continues to fall against the dollar. This could create new buying opportunities for raw materials for US-based buyers. Oil prices have hovered between $90 and $100 a barrel and have slipped in recent days. Natural gas prices have drifted slightly in recent weeks as winter weather in the north has remained somewhat mild. Meanwhile, gasoline prices around the country have continued to decline, though the lower Atlantic and Midwest regions have seen some very slight upticks. Diesel fuel prices, which also contribute to many fuel surcharges imposed by producers, such as steel producers, showed declines across the board in mid-December. Meanwhile, the VIX, or Fear Index, remains just under that magic 25 point. Readings above 25 indicate a greater degree of market volatility. We continue to watch the VIX closely, as it often serves as a buying signal when volatility drops for a range of commodities. London Metal Exchange 3-month aluminum prices touched a low of $19.75 per metric ton, a price not seen since July of 2010. Our friends at Harbor Aluminum attribute the decline to US dollar highs against the euro and a basket of currencies, lingering concerns about the Eurozone's sovereign debt crisis, and short selling by funds. China's copper imports accelerated to a 20-month high in November, with 452,000 metric tons of refined metal, alloy, anode, and products flowing through customs last month. Prior to November, annual imports were down from 2010 by almost 10%. But as the LME price has fallen, imports have accelerated. However, while Chinese GDP is still quite positive at about 8.5%, it is down on last year's 10% growth, with falling PMI numbers pointing to a cooling of demand. Rapidly rising copper consumption therefore runs contrary to all other indicators, and taking copper's speculative role in the Chinese supply chain, it is more likely that we are seeing a mini repeat of the 2009 restocking, when China imported massive volumes of all metals to replenish stocks and take advantage of historically low prices. Meanwhile, steel prices have seen some lifts during this fourth quarter, particularly for hot-rolled coil, cold-rolled coil, and hot-dip galvanized. However, plate prices remain flat and have fallen slightly throughout Q4. Our friends at Gerdau Market Update still point to several factors that have kept flat-rolled product prices from rising, primarily service center inventory levels, construction spending, and durable goods orders, which have slipped slightly. In this month's one-on-one segment, I sat down with my London-based colleague and MetalMiner co-founder, Stuart Burns. Stuart is a regular contributor to MetalMiner and has an ownership stake in a specialty metals distribution company. We thought it would make sense to get the European perspective on the economy, as well as Stuart's unique insights into metals markets. Stuart, how much of an impact on metals demand do you think we'll see with a slowing China?
Yeah, that's a great question. That's one that's on a lot of people's minds. I think the important thing to remember is that we've got a slowing China, but we haven't got a stopping China. China's going to continue to grow. We're probably going to see 8.5% growth in gross domestic product. We're going to see construction continue with massive investment in social housing. So I think the reality is that we'll see China as less of a driver in terms of global demand for metals in 2012 than we saw maybe in 2010. But for metal prices have dropped so much that in certain metals, such as nickel, such as aluminum, and to a certain extent zinc, it's getting towards the cost curve for Chinese producers. And imports could actually continue to run at quite significant levels, possibly even increase from where they are at the moment, because domestic producers in China can't afford to compete at the levels that metal prices have reached. One issue I wanted to catch up with you and get your opinion on was, where do you see steel prices going in 2012?
That's a great question, Stuart, because we're seeing some interesting dynamics even looking at our own MetalMiner index. First, we're seeing that prices had troughed sometime in the third week of November. And since then, we've seen some upticks both for hot rolled coil and cold rolled coil, as well as hot dip galvanized. We've also seen some new support for scrap prices as well. So those are all, suggesting prices are kind of coming up a little bit. Now, where they go is another matter. What's curious, though, is steel plate prices still appear to be sliding, even though they're sliding quite, from a small amount from week to week, but still they're sliding a little bit. And so, I think steel prices are going to kind of bobble a little bit, but I think we're going to see the same trend that we've seen in the last 3 years, with sort of a slow ascent through Q1, maybe into Q2, and then prices coming off once inventory levels have been reached. And I think, inventory levels are going to be reached earlier in 2012 than they were in previous years. So I don't see a big sell-off, but I don't see the same percentage increases, certainly not double-digit increases that are going to be sustainable throughout 2012. I'm going to turn the page now and ask you another question, Stuart. What's your take on non-ferrous metal prices for 2012? I know aluminum is close to your heart, so where do you see markets going in 2012 on the non-ferrous side?
The market has already factored in a lot of the bad news out there. It's factored in fear of what's happening in Europe, concerns about a slowing China, and we've seen prices come off quite dramatically during this year. Now, many of those metals are getting close to their cost curve. For certain producers in certain countries, it's uneconomic to produce some of these metals. So I think what we'll see is a floor under the price for some metals, such as zinc, such as aluminum probably. Although there's no great driver to push those price levels any higher than they are at the moment, I don't think we'll see them drop too much further. The big issue really, I think, in the metals markets is the degree of restocking that is going to go on in China. I think if I was a buyer at the moment, I'd be tending to live hand to mouth. I don't see any news out there to suggest that metal prices are about to take off.
What's your take on the LME markets for the contracts for moly and cobalt? How are they doing? What are we going to see for them in 2012? And then the second part of the question is, what are some of the commodity risk management strategies you think buyers can avail themselves of next year?
Well, I think as far as moly and cobalt are concerned, it's still very much early days for those metals on the LME. We've seen in the past when new contracts have been introduced, it happened with aluminum, it happened a few years ago with steel billet, but it was really only superficial trade interest that became involved in the markets to begin with. The major producers and major consumers tended not to get involved in the market until there was enough liquidity there to make them confident that the price levels were a true reflection of what was happening in the wider marketplace. So I think it's going to take time for moly and cobalt to take off. I do think they've got a future, and I think in the long run it'll provide a great market for particularly for processors in the marketplace that are having to hold moly and cobalt. It will give them the opportunity to hedge their risks. But I think it's still going to be another couple of years before those markets have got enough liquidity to be meaningful. If I was a buyer in today's market, I think I would be have one eye on the long term and one eye on the short term. I think as far as the short term is concerned, I'd be living very much hand to mouth. I think in terms of the long term, I think we are seeing prices for many metals, as I mentioned earlier, close to the cost curve. And current price levels could be, in the medium to long term, a good place to be hedging from. If you have the mechanism to hedge more than 3 to 6 months out, you have access to futures markets where you can lock in prices for the long term with suppliers. Sitting here in Europe, in the midst of a euro crisis, we look with some envy at what's happening in the US and the resilience of the economy there, how it's come out of the last crisis, defied quite a few critics. What's your take on the US economy and its impacts on metal prices next year? Because it could be a big driver.
Well, I'm a bit of a glass half full kind of person. I think I'm leaning towards cautious optimism for 2012. We've got an energy sector that, quite frankly, is on fire, that's driving a lot of metal demand. We have an automotive sector that, though it hasn't returned to pre-recession levels, is definitely in growth mode. It's done better each year since the recession. Those are two great drivers. I think I mentioned commercial construction kind of up and down, but slightly trending up. And I think we're at the bottom of the residential housing crisis. And so I think there's only one way to go there, and that's up. Are we talking 5% growth? No way. I think we're still going to be in that 2.5%. If everything goes well, if we avoid a European debt crisis, if we avoid Asia, or in particular China, going into hard landing mode, I think as long as they're in soft landing, as long as the euro's in check, I think the U.S. ought to be doing fairly well in 2012. So we are somewhat optimistic. Let me take a moment to flip the question back to you. I know you're based in London, but hopefully you can share with us some of your perspective on where you think the European markets are going for 2012.
Well, the Europeans don't agree with the Brits at all about what's happening in Europe, so I don't know how valid my response would be, but looking at it from here, it's almost a game of two halves. On an industrial level, Europe's doing okay. You look at the PMI figures and so on for the core countries such as Germany, France, and although we're not part of the euro, the economy here in the UK, from a manufacturing point of view, is doing all right. When you speak to manufacturing companies, they're ticking along relatively well. The Germans were doing very well up until a few months ago. Exports were phenomenally strong. And that's going to carry through into 2012. The worry is that the euro crisis begins to impact the banks, and then the banks cut off funding to industry and to commercial enterprises. And that's the great unknown. Now, are the politicians going to reach some form of agreement and solve this problem, or are they going to continue to prevaricate and delay things as they have done for most of this year? The omens are not good, I have to say. And I think I'm not alone in suspecting that Germany and France in particular have already discounted some of the peripheral states from the future in the euro, but we'll have to wait and see. I don't think the Europe is going to take off with strong growth next year. I think at best, even if it avoids a recession, it's going to be flat. So we can't look to Europe to pull the world into growth mode next year.
Great. Well, thank you, Stuart. We appreciate you joining us today and wish you a good evening.
Thank you very much. It was a pleasure.